Welcome to the 8 Steps to Financial Fitness with Old Mutual. I am your host, Suchaba Greba. So in the previous workshop, we spoke to Michael about diversification, risk, and time. Today, we're joined by Zain Wilson, and we're speaking about long-term investing. What is long-term investing?
That's a great question, and I think especially given the year we've had, when you've had very volatile markets, and I mean, if I think about a friend that called me in July, she has been looking after her dad's retirement. And she calls me in the middle of July after the markets had a 30% drawdown and was like, what do I do now, Zain? Because I've obviously seen my mom's savings being cut from X to 70% of that. And it's a very emotional thing, right? When you have this massive volatility and big drawdowns in the market. And I think like a lot of things that we deal with when we think about short versus long term, the temptation is when you have an event or something happening today, you get sucked into how do I react, and you're not proactive about what your long-term plans are. So when we think about long-term investing, we kind of split it into two core things. The first thing is completely emotional. So that's exactly what I just described to you now. And if I can compare it to if you're studying for an exam, if you're going on a new diet, or if you are beginning a new exercise routine or you're training for a sport. When you've had a long layoff and you start after a long period of time, so I think for myself, I run quite a lot, and then I took a break. And that first run that you start again after 3 months off is horrible, it's horrific. You don't want to go out, you don't want to get up in the morning. The first kilometer is horrific, your legs feel horrible, and all you think about is the short-term pain that you experience today. But the reality is, what you're running for is for a long-term plan. You know it's good for you, you know it's going to make you healthier and fitter. So if we take our mind psychologically and emotionally away from the event that happens today and the pain you feel today, and you align your kind of habits and your planning with the horizon that you're actually trying to achieve your goal in, that's the first key thing about investing. It's about aligning your horizons with what your goals are, so objective-based investing. The second part, which is kind of about how assets generate returns in the long term, right? It's about compounding. And there's a great quote by Albert Einstein, and I'm sure I'm going to butcher it, but the quote is basically, compound investing is the 8th wonder of the world. Those who know it, earn it, and those who don't, pay it. And there are two parts to this. So the first part is, if I had to give you 100 Rand today, and you had to assume like that 100 Rand grew by 10% a year, I'm not going to ask you to answer it, don't worry. Our brains think, the way our brains do that maths, right? We'll think, okay, how long does it take for that 100 Rand to double and become 200? Like the intuitive thing you think of is 10% a year, it should take 10 years, right? And then your money doubles. But the power of compounding is that actually, when you have 100 Rand at the beginning of the year and it grows by 10, by the time you start year 2, you have 110 Rand, and that's growing by 10%. So actually, by the time you get to the end of 10 years, you don't have double your money, you have 2.6 times. So the compounding is about that extra interest and extra return you get over long periods of time. So the first part is that we call it reinvestment component of compounding. The other part about it, or the most important part about compounding, is actually time. So time is your friend. So same example, over 10 years you go from 100 to 260 Rand. Over 20 years you go to 770 Rand. So it does more than double. And over 30 years, you go to, I think it's 1,800 Rand. So I obviously did those numbers beforehand. I didn't just think it up on the spot. but the key message there is like the time.
But
right?
Is this what compounding is?
Yeah,
okay.
Compounding is, if you think about it in a sports kind of analogy, at a very high level of competition, right? The difference between the guy who comes first, so Usain Bolt, and the guy who comes 10th, is all those marginal differences in his training, in his starting, in all the bits over time. And even those individual marginal differences add up. They add up a 3 or 4 second lead when it comes to the final race. But you don't see it in the incremental gain, you only see it over time.
And how do shares respond to time?
Shares are probably the most bipolar example in investing of how they respond to time. So if I think in the very short term, on a daily basis, shares can be up 5% or down 5%, and it's kind of chaos, right? And what shares are responding to in the short term is often news or events and things that we can't predict. And
so is it safe to go that route?
It depends. So this goes back to what are you investing for?
Okay.
I don't know anyone who invests for a day. You should align your investment strategy with the horizon you're trying to save for, right? So most of us are investing for a home or for our kids or for our retirement. And that's not a 1 or 2 day horizon or even a 1 year horizon. It's a 10, 20 or 30 year horizon. And the key point here is that although there's a lot of volatility and noise in the short term, if you think about what shares do over the long term, what actually happens is it increases your chances of growing your money because you compound at a much higher rate than you would compound versus cash. And I can give you an example of what those numbers are in a second. But the other important part is as you stretch your holding period out, so I hold my shares for 10 years versus 1 day, then your chances of having losses decrease. So we looked at 90 years of data. So a lot of people say long-term investing and they talk about 5 years or 10 years. When we look at 90 years of data for the SA equity market, so that's the JSE basket of shares in South Africa, diversified, over any single year period, your odds of getting negative returns are fairly high.
Okay.
Well, not high, I don't want to say that. But as you roll out to 10-year periods, your chances of getting a negative return is only 1%.
Oh, wow.
So if you split those two things, the fear of the short term over 1 day versus the returns you get over the long term, you can see how it fits to the kind of exercise analogy, right? You don't want the short term pain, but to get that long term return, you have to be invested, and you have to be invested in a diversified basket of shares.
You are right about people being discouraged easily, but why shouldn't one disinvest when the stock market goes up and down?
So where does your money go to, I guess, is the question. So the two polar opposites, and what people tend to do is you either have stocks or shares and you have cash, right? And again, we'll take it back to the long-term example. Over the last 90 years, shares have given you 13.7% over 90 years on average, and cash has given you 6.9%, right? So we touched on the effect of compounding and how that's kind of exponential and how it creates returns. So the gap between what you'll grow with your shares versus what you grow with cash becomes exponential. So the temptation is you have a market crash, right? Like we had this year, and things are horrific and everyone panics. And then equities and shares go down and you want to take your money out and put it in cash.
Should you then?
No,
Okay.
because what that's going to do is you take your money, you put it into cash, you're guaranteed to get, right now, 3.5%, but you're guaranteed to get nothing more than 3.5%.
Okay.
Whereas buying shares when they've come off, as long as you're buying a diversified basket of shares that give you exposure to the best companies in the country, which is what the JSE will do, then the hurdle of passing 3.5% is quite low, especially if you think about the longer horizon.
And how does time affect the value of cash in the long run?
The main thing with cash is that, so shares 13.7%, cash 6.9%, right? So 6.9% sounds fine. It's not like you're getting negative returns and you get certainty, so you're not going to lose your money. And the fear with shares is you lose some of your money. But the problem with cash is that 6.9% is only a little bit higher than inflation. So inflation has averaged 6% over the last same period, 90 years. And if you're investing in something that gives you 6.9% versus the value of your money is decreasing by 6% a year because of inflation, so your cost of living is going up, then you're only actually growing your money by 0.9% after inflation a year with cash. So go back to the example where you had 10% over 10 years, right? You turn 100 Rand into 260. If that was in cash returns, that would turn 100 Rand into 109 Rand over 10 years.
Okay.
So it becomes impossible to meet your investment goals if you're investing in cash over longer periods of time.
Okay. So Zain, if someone is listening to this video or watching this video and taking from it and wanting to invest, what would you recommend for them to invest in?
I would say that the first thing is to make sure you're
Looking at from a long-term perspective.
Always make sure that you start off with your plan, and your investment style and strategy is aligned to the horizon that you're saving money over, right? And most of us are saving 10 plus years, so 10 to 30, it depends where you are. And if you're saving over that horizon, the bulk of your savings must be invested into assets that give you that ability to grow your wealth.
Okay.
So it's not necessary that you're going to have 100% of your money in equity, because sometimes that does poorly, sometimes it does better. but you need to have it invested in a portfolio of assets which gives you enough growth assets so you increase the chances of meeting your long-term goals.
I love it. Thank you so much, Zain. This has really been educational.
Great, thanks, Chef.
All right. I think the one thing that I've taken from this particular workshop is we need to think long-term and not look for instant gratification. Just remember to look out for more of those workshops taking you through your journey of financial fitness. My name is Suchaba Deba. Till next time.